The Federal Reserve began raising them in early 2022 to fight inflation. And while the Fed is projecting 3 rate cuts this year, its Federal Open Market Committee most recently voted to keep rates where they are. Mary C. Daly is a voting member of that committee and the president of the Federal Reserve Bank of San Francisco, which serves 9 states, including Nevada. I asked her about that decision and about her economic outlook for Nevada when I moderated a fireside chat at Windmill Library. What would you say, though, to people here in Southern Nevada who are perhaps waiting on interest rates to be lowered in order to buy a home, to refinance, or to even put their home up for sale, thinking it'll make their home more competitive, about the Fed's decision not to cut rates?
So that's a terrific question. And I want to answer this in 2 parts. So the first part is that we're making progress. All the interest rate adjustments we've made have shown through to lower inflation than we had a year ago. We have an economy that's coming back into balance. The labor market's coming back into balance, both because demand for workers has slowed, but also because supply of workers has improved. And so we're seeing the signs that monetary policy is working, and that's very good news as we think about where's the path of interest rates going forward. The second thing I'll say, though, is that we're in a world that was completely unsustainable. We were in a world where house price appreciation was rising, and people couldn't afford homes then either. So what we're doing, the part of our job that we do in the housing market, is to balance the economy so that we don't have inflation chewing up affordability. But we do have a supply and demand imbalance in our nation, and that's not just here in Southern Nevada, it's across the country. And that is going to take the work of people, not Federal Reserve officials, but people to bring that supply and demand back into balance. But if you're looking to think about when am I going to be able to get back in the market, the economy is improving. We are seeing inflation come down, albeit gradually, and there is a path in my mind where interest rates start to adjust this year. We're just not there yet.
What's the risk of cutting interest rates too soon?
The risk of cutting interest rates too soon is a real risk. We had a roundtable before we walked in here with workforce and community leaders, and you can really see the vestiges of the long tail of high inflation. It does take a toll, and so the risk of cutting it too soon is that gets locked in. Right now, we're not at price stability. If we lock inflation in at this level, that is just a toxic tax on everyone, but it really hits hardest people who are least able to bear it. And we've already seen some of that occur. We don't want to continue that. We want to fully bring inflation back to our 2% target and restore the balance in the economy that's necessary to maintain that.
Now, the Fed has indicated it expects 3 interest rate cuts this year. Is there any reason to doubt that will still happen?
So I think that is a very reasonable baseline, but I would like to say here that this is a projection, right? 3 rate cuts is a projection, and a projection is not a promise. And I think that's really important because a projection is saying, here's how the economy is expected to evolve, and here's how policy evolve should that occur. But you have to maintain this ready position, and I feel like we're in a very good place to be ready.
Here in Nevada, a recent study out of the University of Nevada, Reno, found that of all the businesses in Nevada, 98% are small businesses. What have you heard about the impacts on them that these interest rates have had, and what would you tell them?
So one thing that really is important is small businesses make up most businesses in the United States, and here in Nevada, they're an extremely large percentage, and they're an engine of growth. And so we want to think about the health of small businesses. And during the pandemic, of course, small businesses were very negatively affected by the closures. Then we come out of the pandemic and it's hard to find workers and input costs are rising and margins are squeezed and people are just trying to hang on. This morning, we heard that depending on which sector you're in, businesses are thriving. The volumes are good, right? People want to come and buy the proceeds. They want to buy the products. They want to come and eat dinner or lunch, etc. But you're still facing hard time finding workers and high input costs and trying to meet your margins. And so over time, that's a strain. And it's a strain on all businesses, but for small businesses in particular, really trying to figure out how do we get through this? How do we make sure that we can manage these competing things? The sentiment, though, when we look at the sentiment in all of the states, it doesn't seem to be getting worse and worse and worse. It's just not getting better and better and better. We're sort of in a holding pattern of, wow, we're relieved inflation's not 7-8% anymore. We're relieved the labor market slowed a little bit, but boy, it's not continuing to get better at a rapid clip. And so there's still some question out there about when will the true relief come? When will we be completely back to, well, in economist terms, we call steady state. I think in everyday parlance, we call normal life.
Las Vegas's venture into sports, the explosion of the sports industry here, do you really consider that economic diversification, or is it just more entertainment?
So I think of it as there's two ways to diversify, or there's multiple ways to diversify, but I think importantly, here in Southern Nevada, I'm seeing both. I wonder if you agree, but here's what I'm seeing and hearing is that there's a diversification of you want entertainment to come here. You want to be an entertainment capital. That was gaming, but not everybody gambles. So, okay, now we're going to add shows and nice restaurants. And so that expands the clientele, but it also expands the length of stay because, you know, families might come, some gamble, some see shows, they do things collectively. Now you add sports and you're covering a portfolio that most American consumers partake in. If you put concerts, other kinds of shows, gambling, and sports, I mean, that covers a lot. Plus, it's a beautiful area. You can hike and bike and partake in good weather. Then that's a really large span. So that's one type of diversification, but it's very consumer dependent.
What are your thoughts about a recession in 2024?
So it's interesting. If you, and if I may, I'm just going to pull out my economist hat for a second and say that if you run any statistical models or you look at history, there's always some probability of a recession because it's just, that's what, you can always have something. But what's really important to know is it's not very high right now. It's sort of what we consider normal. And that normal is what I see when I go and talk in communities, because the ingredients of a recession are really, absent some shock, some unexpected event, they're really that you see weaknesses emerging. And we don't see weaknesses emerging. I see the economy coming back into balance, but look at the labor market. It remains strong. We have good job growth. We have opportunities. Job vacancies are still higher than available workers. So there's still more jobs than there are workers looking for work. And so that's obviously a strong labor market, healthy labor market. Inflation's coming down, but we need it to come down more. And so I see the probability of recession is not being something that's worrying me. I didn't have a modal outlook for a recession last year, and I don't have one for this year. What I have is sort of the case where is how quickly will inflation come down, and what will we then do with the path of interest rates?
Help us understand this. Back in 2023, Nevada had the highest job growth in the country, but also the highest unemployment rate. How does that make sense?
So what I learned in the roundtable is going to help me, but I'm going to start with where I am as a labor economist. So what you learn is that sometimes rapid job growth causes a lot of churning in an economy. So job growth is rising rapidly. People are seeing new and ever new opportunities, and so they move back and forth. But as you move from one job to another, you often have a spell of unemployment, which raises the unemployment rate. The other thing that's true is the younger your population is, or the newer to work they are, or if you're getting new people moving into the state to take job opportunities, they have a period of higher unemployment. So those two things are not necessarily contradictory, that you can have rapid job growth and rapid changes, adding new industries, et cetera, and you can have people who have spells of unemployment because they're searching for the best opportunity for them. And younger workers just search more and are in and out of work more than more experienced populations. That's just a fact of how the labor market works. But something I learned today in the roundtable is that, and it makes a lot of sense, when you bring a new industry in, like lighter manufacturing, and you're building it up, it takes time for people to say, oh, I might want to work in that industry. So they have vacancies that don't go filled while people stay without jobs looking for a job that fits them. And so I think that's just part of a natural process that you have to make sure people know about the jobs, know about the opportunities they bring. But this is the third thing that we can have all of you here have a lot to say about, which is you've got to train and make sure your workforce is ready for the new opportunities coming in. So whether it's moving workers from the back office operations in gaming to the front office, or it's moving people who were in, entertainment into light manufacturing and helping them get the training and the mindset that says, oh, those are good opportunities. That's just going to take time, but it has to be done in order for that unemployment rate to come back into better balance. What you ultimately want is good job growth and a low unemployment rate. But I think that's a process that I know you're working on here and will continue to need effort.
The importance of putting a story to a data point.
Yes.
You hold that very dearly.
I do. Is
there an example you have of a Nevadan you've spoken with? They've told you something about themselves and it's helped you better understand a specific issue?
So I'm going to go, I love that question. And you see my tone change a little bit because, so I'm a rookie economist. I just gotten my PhD, went to my postdoc. I started the Fed in September of 1996. And my first out of the head office San Francisco assignment is to come to Las Vegas. So I come to Las Vegas. We're in early 1997. And I'm going to do an event in the evening. And so I arrive around 11 o'clock. And it is in the spring. So school's in session. It is not spring break. And I pull up my car, because I rented a car, pull up the car, and valet parking me are kids who look like they're in high school. And I say, why are you out of school? Is it a day off? And he said, I still feel emotion when I see this. He said, no, I dropped out because the labor market's strong and I can make more parking cars and I need money and I want money. Mostly it was need, sometimes it was want. And then he said, and all my buddies are here too. And I look and it's like half of his high school, it felt like half of his high school class, but it was at least 10 guys and they're all parking cars. And that is a tragedy. And so it is because, if you trace the data for those students when they're young and you look at what their earning trajectory is, they don't actually ever rise that much above that level of income they were getting unless they go back for training. It's hard to go back for training when you don't have a high school degree. So it was the first time. I'm a labor economist. I'm like, wow, a strong labor market. Who could complain about it? And what I realized is a strong labor market is great. A frothy and overheated labor market has consequences that we don't even see. And that consequence that I witnessed right there in my first outing outside of the head office was here in Las Vegas. And it made me realize why the balanced economy and the dual mandate are so important.
Wonder how much you think it's improved since then.
Unfortunately, I'd heard the same story today. And so here's the reminder for all of us. You asked me at the beginning, what do I say to people who are trying to buy a home about interest rates? The higher interest rates we have are to bring down inflation. If we bring down inflation and the economy comes into more balance, then yes, homes become more available and affordable, and mortgages do as well. But those kids make decisions that are better for their long-term future. They're probably making, honestly, the exact right decision for their current situation. They've got to often help their families, help themselves. They can't afford the things. But that's what a balanced economy offers. It offers the opportunity to step away from making just-in-time decisions to making decisions that last a longer period of time. Now, I dropped out of high school myself and went back and got a GED eventually. But I dropped out of school because my family needed income. I grew up in I was in the 80s, high inflation, and then the Volcker disinflation. And it was a meaningful time because people in my community went from fighting high inflation to not having jobs because the Volcker disinflation came. And so you ask me, people do ask me, why do you stay committed to bringing inflation down? Because that Volcker disinflation is not something we want to have to do again. So we don't want to run the risk that inflation gets locked in and you really have to force it, because people want both things. They want price stability and they want a job. And that's what we're doing. That's why I take the great responsibility here as an honor that I have at the Federal Reserve, because it's an honor to try to work hard to deliver those two things.
What was the job that you took when you dropped out of high school?
I drove a donut truck. So I had 3 jobs. I drove a delivery truck for donuts. I then got a job washing the donut machines, and I was 16. And then I also worked at a side gig at a department store, which I've learned to not name. But no, I think it's okay. I mean, I was 16. It was Target in Missouri. So I worked all 3 jobs, and, my aspiration was to be a bus driver because I could have one job in benefits. But I was fortunate. I meant a mentor. And you asked, what can we all do for workforce development? A mentor saved that, changed my trajectory. That was what I wanted to do. I didn't even know I had to have a GED to get a bus driving job, but she taught me that. And then after I got my GED, she said, you could go to college, just take a semester. I didn't have the money to pay for my first semester, so she wrote a $216 check. I went, and now I'm here as president of the San Francisco Fed. So it's possible.
You talk about the importance of a balanced economy, but I think economic diversification plays into that.
It does,
absolutely. Here with what kind of jobs are available. And so back to sports with these teams and these stadiums that are being built. I mean, the Tropicana closing today.
So that, yes.
In its place is set to be a Major League Baseball stadium. The jobs that stadiums and these professional sports teams provide, what does that do to address the wage gap in Southern Nevada?
I live in Oakland, and people are boarding that plane all the time from Oakland, LA, coming to Las Vegas for the weekend to do things on Friday night, all day Saturday, Sunday morning, then see the Raiders play on Sunday, then they go home. And so that is more of an experience that you're investing in, and those experiences are just part of that whole equation that Las Vegas has had for so long. So I think of that as is probably, and I didn't talk to the people who thought of these ideas, but I have talked to people here in Las Vegas before who said our plan is to just create experiences and have people show up for a weekend for experiences, sometimes even a week, instead of just, you go to the stadium and you see the game and then you go home. And that is less of a job creator than these experience-based investments, which I believe the people thinking about this are trying to do here.
The Fed's next meeting is in May.